Overall, I think people that run our businesses that do have any sensitivity to the economy are surprised at where they are now compared to where they thought they were going to be 6 months ago. That doesn't mean the world is coming to an end or anything.
Hello and welcome to Financial Fortune, the channel that provides you with the latest updates and insights on the world of finance. As one of the most successful investors of all time, Buffett's insights are highly sought after by investors worldwide. Warren Buffett flew CNBC's Becky Quick to Japan for a 2.5-hour interview in which they discussed, among other things, the economy. In a rather peculiar turn of events, Buffett and future Berkshire CEO Greg Abel are in Japan to meet with the 5 trading houses in the country, in which they have invested since 2020. However, the focus of this video is not on Buffett's investments per se, but rather on his views on the health of the banking industry and the safety of the United States as a whole.
So let's talk about what's happening in the banking sector right now. Is this a banking crisis? Is this financials in turmoil? Is this banking crisis 2.0? What would you call what we've been seeing happen?
Well, I would say that some of the dumb things that banks do periodically have become uncovered during this period, and as one of banker told me one time, he says, I don't know why we keep looking for new ways to lose money when the old ones are working so well. And they made the same mistake, some banks, in this period they haven't made as many mistakes. They expect to make some mistakes in making loans, but they haven't, and particularly if you're getting into credit card loans, I mean, that's just part of the game. But they haven't made the same sort of mistakes that they made back in 2008 or 9. But they have mismatched assets and liabilities, and bankers have been tempted to do that forever, and every now and then it bites them in a big way. And it's just amazing to me that banks could make presentations to financial analysts and everything, and if one bank bought a bond at 100 and another bought it at 96, and they both held a maturity. One bank carries it at 100 and another bank carries it at 96. I mean, it is accounting procedures have driven some bankers to do some things that may have helped their current earnings a little bit and caused the recurring temptation to get a little bit bigger spread and report a little more in earnings, and it's entered in a result you could predict. You couldn't predict when it would happen, and then once they start looking at one that does it, then they start looking at others, and pretty soon, that everybody is in a position of looking at a number that nobody looked at when it was presented to them a year ago, if you read the 10K or anything of the sort. But the banks did not call attention to what they were doing when it was going on, and I would read investor contact when they would have meetings with financial analysts or the people who follow banking, and nobody even brought up the point virtually. And believe me, if we've got a $50 billion loss or something in Berkshire, we would expect people to know about it. And it's happened before. It's happened this time. It'll happen again someday.
Did you see this? You were reading through the reports. You followed all these banking earnings that were coming in. So you noticed it. You saw it?
Sure, I noticed it.
Is that why you sold so many of the banking stocks you owned?
We sold a number of banks. I mean, we had held some of them for 25 years, but I don't like it when people get too focused on the earnings number and forget what in my view is basic banking principles. I'm not going to get into naming any names or anything like that, but it happened to varying degrees throughout the industry. And the politicians say, well, the big banks did this. That isn't true. I mean, I know who has been holding long-term instruments, and if let's take commercial mortgages or something of the sort. they carry them at cost, basically, and they can't sell them at that cost. And it's important that banks retain the confidence of the public, and they can lose it, in seconds. And we saw a country that was not worried about banks, until about Wednesday or Thursday of the week when Silicon Valley fell apart. And then all of a sudden everybody was worried about it all over the country. And the interesting thing, of course, is that it will not cost the government a penny. I mean, people think that, that somehow the government's going to get hung up with us. The FDIC is in effect, a very peculiar mutual insurance operation that is run by the government but is financed by the banks. And FDIC had 120 billion or so at the start of the year, and that's all money that banks have paid in, less what the FDIC has had to pay out on losses. The FDIC has to pay out 250 billion this time, or 300 billion. They just assess the banks more, and they don't do it in a very business-like manner because the public has the impression that the FDIC is the United States government and that so on. And of course, they do appoint the people, but the costs of the FDIC, including the cost of their employees and everything else, is borne by the banks. So banks have never cost the federal government a dime. But that the public doesn't really understand the whole FDIC thing, and the comments of public officials confuse it and the issue enormously. Somebody ought to write. I mean, the FDIC was set up to operate on, I think, January 1st, 1934. You'd think somebody would have gotten through to writing what's the essence of this FDIC, which was a fantastically good development of the New Deal. I mean, 2,000 banks failed in, I don't know whether it was 1920 or 21. Well, there's only, I don't know, something less than 5,000 banks in the United States. And I mean, it was a paralyzing thing to have a bank failure in this country. And my dad lost his job in 1931. He lost his savings. And it was because a bank failed that he worked at downtown in Omaha. And people shouldn't be worried about losing their money and the deposits they have in an American bank. And today they have no reason to worry. But the message has gotten very confused, and people don't really understand how it all works. And politicians can make hay out of it, and all kinds of things. Bad things happen when people don't understand some major institution and who actually bears the costs and what the responsibilities are. And nobody is going to lose money on a deposit in the U.S. bank. I don't know about the rest of the world. I don't know. I'm not that familiar with it, but it's not going to happen. And that message has gotten mixed up. I just think the system isn't set up quite right in terms of connecting punishment to culprits on something that's it's incredibly important that your banking system run well in the country. I mean, it just isn't going to work unless you have a banking system that works, and you don't want them to create periodic crises unnecessarily.
Okay. Now, let me just ask you about the economy. We have heard recently from Jamie Dimon in his annual letter at JP Morgan. He says a recession is much more likely now. Janet Yellen was just speaking, I think in the last 24 hours, although it's hard to track from here when things are happening, has just said in the last 24 hours, I think, that the U.S. is in better shape now than it was 6 months ago. Which of those camps would you put yourself in? Well,
I know what a lot of different businesses are doing, and I just got a report from one of them that happens to be in the retail-related business. And in any event, it was minus 22% in February from a year ago. They didn't think that was going to happen.
Sales? You mean, or profit?
Yeah. In sales. Profits are down a lot more than that. On the other hand, some of our businesses are still doing fine, but they all are reporting that some of them are living off of orders were placed months earlier and that sort of thing. But it's a tougher world out there in a great many businesses, not in the insurance business, Insurance business should be better this year than last year. That doesn't mean it will be, because we can't predict everything that happens, but on a probability basis, it should be better than last year. And the railroad business is down in carloads carried, but it isn't dramatic. And of course, we've got a utility business, and that doesn't really vary much with things. But overall, I think people that run our businesses that do have any sensitivity to the economy are surprised at where they are now compared to where they thought they were going to be 6 months ago. That doesn't mean the world is coming to an end or anything, because 58 years I've been running Berkshire. I mean, we've run into all kinds of problems, but that's what business is about. And we run our business so that we don't depend on everything being big hunky-dory always. We run it so that we will be the last man standing. And that's the way, if millions of people are going to give me their money and tell me to take care of it, we're going to try and take care of it. And if we don't make as much money as we might have if we'd leveraged more or done other policies, so be it.
But you think a recession is more likely now than maybe you would have said 6 months ago?
Well, I think most of our managers would say that they are surprised at where they are now compared to how they thought they were going to feel 6 months ago at this point.
And
in a lot of businesses, but not in the insurance business, you know. But I think the people at the railroad are somewhat surprised that car loadings aren't a little higher rather than a little lower, you know, somewhat lower. But most of the stuff we carry is essential, but it reflects what's happening. And of course, supply lines were so disrupted and everything a year or two ago that, you know, no economic figures are pure.
In terms of the potential for a credit crunch coming through what the banks are going through right now, there's been a lot of speculation about what that could mean to the economy. Is it going to mean a 0.5% hit to GDP? Is it going to mean a 1% hit to GDP? What would you guess?
I would say that I've been in business running Berkshire for 58 years, and I've never found economic forecasts of any use to the company. And all we have to do is keep running every business as well as we can, and we got to keep plenty of cash on hand so that people can keep making intelligent decisions rather than those forced upon them. And that's all we know how to do. And if I depended in my life on economic forecasts, you know, I don't think we could make any money. I don't know how to do it. And you know, people want to get them, so they get them, but it has no utility. When I find one of our companies has hired somebody to tell them what's going to happen in the economy, I mean, they've thrown the money away as far as I'm concerned.
That's all for today's video on Warren Buffett's predictions for the 2023 economic recession. While no one knows for sure what the future holds, Buffett's insights are always worth considering when it comes to investing. As always, if you enjoyed this video, please like and subscribe to our channel for more content on finance and investing. Thank you for watching, and we'll see you in the next one.